In this short video, we're going to look at the process to determine viability ratings for banks. The process to assign a viability rating, or VR, can be broken down into three main steps. First, we determine a score for a bank's operating environment, or OE. Then we derive scores for 6 other rating drivers. Finally, we combine the 6 scores to derive the VR. The OE score captures Fitch's assessment of the ability of banks in a given jurisdiction to generate business while taking on acceptable levels of risk. Fitch derives an implied OE score using the matrix shown on this slide. The matrix incorporates 2 core metrics, GDP per capita and a ranking using Fitch Solutions Operational Risk Index, which captures the challenges of operating a business in a given jurisdiction. As a next sub-step, Fitch considers whether to adjust the implied OE score before arriving at the final, notch-specific, assigned score. Possible adjustments to the OE score may stem from the size and structure of the economy, the macroeconomic stability of the country, and the regulatory and legal framework, amongst others. The second main step in assigning a bank's VR is determining the scores for the 6 other key rating drivers, or KRDs. First, Fitch derives implied scores using 2-factor matrices for most rating drivers. The OE score is one of the 2 factors. The other factor in each matrix is a core metric most closely related to our assessment of the given driver. For example, the impaired loans ratio for asset quality. We use 4-year averages except for capitalization and leverage, which uses the latest available data point. This slide shows the matrix used to derive the implied score for asset quality. The way to read this is as follows. Suppose a bank's assigned operating environment score is A-. That is to say, it is in the A category. This puts us in the second row of the matrix. Then suppose the 4-year average for the impaired loans, or gross loans ratio, is 7%. That is below 12%, but more than 5%. This puts us in the second cell from the right in that row and gives us an implied asset quality, KRD score, in the BB category, as indicated by the heading at the top of that column. As a next step, Fitch considers whether the implied scores should be adjusted. This slide shows the possible adjustment factors for asset quality, which include, for example, collateral and reserves, non-loan exposures, and underwriting standards and growth. The third step is to determine the implied VR by combining the 6 assigned KRD scores using the weightings shown on this slide. Fitch then considers whether the implied VR should be adjusted to arrive at the final VR. There are 3 possible reasons. Fitch can assign a VR lower than implied, where we think the implied VR is too high, relative to the operating environment score or the sovereign rating. The implied VR can also be adjusted if Fitch believes that business profile or risk profile should have a stronger impact on the VR than the weighting would suggest. Finally, the assigned VR can be lower than implied when 1 or more financial factors represent a bank's weakest link, dragging down the VR based on its strong impact on our overall assessment. The weakest link adjustment is usually 1 notch, but can be more at low rating levels, particularly when a bank nears failure. For more on the fundamentals of Fitch's bank rating criteria, view the other videos in the series.